What's up, everybody? Welcome back. Today, we're going to be talking about a very troubling statistic that I recently noticed in SoFi's latest earnings report that is actually a negative on the company. I'm going to be explaining what it is and overall sharing my thoughts on the impact to SoFi's bottom line. Now, the reason I'm bringing this up was a comment that came out of my last SoFi video where I talked about their fourth quarter 2021 earnings and where they're going into the future in 2022. The comment was around SoFi's high stock-based compensation for their employees and the possibility of diluting shareholders. The commenter highlights that it's important not to get confirmation bias, which is something I completely agree with. I'm bullish on SoFi myself, but I always want to present as unbiased an opinion in these videos as I possibly can, which is why I'm making this video, even though this video or this negative sentiment goes against my normal stream of bullish sentiment for SoFi specifically. Okay, so let's jump into those metrics. Looking at this chart, we can see three pieces of information overlaid onto each other. In the blue bar, we see SoFi's GAAP revenue. In the yellow bar, we see their stock-based compensation, and the line overlaying it is stock-based compensation as a percentage of revenue. So it's basically the yellow line divided by the blue line. And this line is where I want to mostly focus my efforts on, because I wouldn't be too concerned about the stock-based compensation if revenue growth was outpacing stock-based compensation. It's pretty normal. So if this line was actually going down, that's what you want to see. You want to see revenue rising much higher than stock-based compensation rising, and this line as a result going down. But for the fact that we see this line going up, it's a little bit troubling, which made me want to dig a little bit deeper onto this number specifically. And of course, the reason for this is if you compare all credit services against each other, SoFi is number one in terms of stock-based compensation as a percentage of revenue at 24.3% according to Business Quant. This is not good. Other companies on average have under 10%. The vast majority of them have under 5% stock-based compensation. Now, this is not a very fair comparison of the industry because all of these companies do different things. Visa and MasterCard are very different from PayPal, are very different from SoFi or Upstart or Lending Club. They're all different companies. They all have different niches within that fintech vertical. Some of these companies are not even tech specific. They're only finance specific. Some of them have negative revenue growth. They're very stagnant, mature companies. But what you'll notice is SoFi, Upstart, and Lending Club, the three fintech players, are at the very top of this list. Now, obviously, it's not good because SoFi has the highest stock-based compensation as a percentage of revenue, despite having the slowest revenue growth. Upstart has over 200% and Lending Club has over 150%. Meanwhile, they have a lower stock-based compensation. So you have to ask yourself, okay, what's going on here? Well, from a bullish point of view, and obviously trying to defend this point, SoFi is very different from Upstart and Lending Club because SoFi is focused on an end-to-end experience, whereas Lending Club and Upstart, they're focused on different niches, like I mentioned before. I mean, you can look at SoFi from all these different angles. They purchased Galileo, so they're playing on the back-end infrastructure. They also got their bank charter, right? So they're going to offer credit and they're going to offer options trading and all of these. They're also playing in the crypto space. Like they're playing in so many different spaces, trying to be that end-to-end experience. And so in my opinion, it's not accurate to be judging this apples to apples, although I do see the numbers in front of me, and it's not good for SoFi, right? At 24% stock-based compensation with a 74% revenue growth, that's not the ideal position you want to be in, especially because these other companies are outpacing SoFi in terms of growth, meanwhile keeping their stock-based compensation at bay. So before we go a little bit deeper into analyzing why this is and what the repercussions are, let's talk very quickly about why this matters. Why should we even care about the stock-based compensation? Well, it's very simple. In this chart, you have the impact to net margins and to the bottom line for SoFi. You have GAAP revenue here at the top, and here in the bottom, you have groupings of what the net loss would be with and without stock-based compensation, what the margins would be with or without stock-based compensation. And to put it very simply, stock-based compensation is just an operating expense. So they have higher expenses essentially. Higher stock-based compensation has a negative impact to the bottom line, has a negative impact to the margins, right? So if I reported a net loss of 111 million for the latest quarter. However, that net loss would have been only 33 million without stock-based compensation. And in terms of their margins, they reported negative 39.5 GAAP net margins in Q4 2021. That would have been only negative 12% without stock-based compensation. And so to summarize this, why it matters is because it's a higher expense, which is obviously going to negatively impact SoFi's profitability, their bottom lines, and their margins, right? And so we've established that this is a problem and this is an important problem to solve. The next question in terms of diagnosing this problem is asking ourselves, is it temporary or is it fixed? Is it something that's here to stay or is it as a result of the current situation? The company management guided in their earnings call that the stock-based compensation expense is going to be increasing by 42% in 2022. This figure stood at 240 million in 2021 as a full year, but they expect it to come in at 340 million for 2022. So the stock-based compensation is not going to go down. It's actually going to go up. It's forecasted to be between 80 and 85 million for Q1. And as we mentioned, 340 million for the full year 2022. Now, this might sound very troubling, but you have to understand that stock-based compensation is a way that companies retain talent, which we're going to talk about in just a second. And then the second point to keep in mind is that the absolute numbers don't matter as much as the percentages. We want SoFi's stock-based compensation not to go down on an absolute basis, but to go down as a percentage of their total revenue. And if you divide 340 million by 1.5 billion, let's say, it's about 20%, 22%, something like that. Currently, they're over 25%. So that number as a percentage of total revenue is going to go down despite the absolute numbers going up. And this is one of my main arguments, is that revenue always grows faster than these expenses, which means that the business eventually is going to break even into profitability. And with that said, we have to ask ourselves, why is this so high when companies like Upstart, companies like Lending Club, companies like PayPal, Visa, and MasterCard, they all have this at bay? Why is it so high for SoFi? The first reason this number is so high is not specific to SoFi. It's actually a macro umbrella of the startup environment as a whole. Startups on average have higher stock-based compensation expense because they need to incentivize talent. And their stock-based compensation as a percentage of revenue is higher because they have overall lower revenue. They're still growing, right? Think of it if you were a software developer. If you worked at Google, you never have to worry about your job security because Google is profitable. They have copious amounts of funding. They can raise money at the drop of a dime. They don't need to incentivize you any further. Now, what would make you as a software developer more likely to work at SoFi versus at Google? Chances are SoFi as a company is going to have to offer you more stock, more bonuses, more perks to counteract that extra risk you take on by working at a startup, because a startup has more risks in terms of securing funding, in terms of turning profitable, in terms of just overall being a successful company. Whereas an established company is already proven itself to be successful, so they don't need to incentivize you any further. And so immediately, just as a result of this paradigm, startups have higher stock-based compensation. And you can see this here. The top 3 in this list are all startups. They're all companies that are growing very, very quickly, but as a result have higher stock-based compensation as a percentage of the revenue pool. Now, of course, this does not explain the big variance in terms of Upstart and Lending Club versus SoFi, but it does explain this bucket versus this bucket down here. The second reason is that SoFi is on a hiring spree. They have about 2,600 employees. Their headcount grew about 9% in the last 6 months, which included a lot of senior management hires. This was because of the bank charter. Bank charter included a lot of leadership roles, a lot of high-earning executive C-suite roles, which generally speaking have a lot more stock-based compensation as a part of the total compensation package. The company is growing fast and they're also expanding into new segments. We talked about in the videos leading up to the bank charter, the anti-money laundering segments, the compliance segments, all of the infrastructure in terms of headcount that they had to hire just to support that bank charter specifically. And on top of this, keep in mind, SoFi has 2,600 employees. They have 460 job openings currently up on LinkedIn. So think about that, right? In order to incentivize more people to jump ship, to come from the Apples, the Googles, the Amazons of the world and work at SoFi, SoFi as a company has to incentivize them with stock. They have to incentivize them with bonuses. And that's where this increased cost comes in, because look at how much they're ramping up as a percentage of their total employees that they have. They're ramping up very, very fast. They're growing very fast. They're opening new segments very fast. So the business is on a hiring spree. The more they hire, the more they offer stock to employees, and the stock-based compensation is much higher as a result. But obviously this is going to pay dividends because that stock-based compensation is ultimately an investment. Because if I started SoFi, my stock is going to vest over a 4-year period, and I'm eventually going to earn out more and more of that stock. But the company is going to incentivize me as a top hire to work there versus anywhere else Finally, the third and the biggest reason for the stock-based compensation is the major acquisitions. In the last 2 years alone, SoFi has had 3 major acquisitions. They bought Galileo in 2020 for $1.2 billion. $875 million of this total amount was in pure stock. They bought Golden Pacific Bancorp, and they invested over $750 million just in the bank charter alone. And it explains the hiring spree as well that we saw in the last slide. They're supporting the physical branches and those locations. They're also ramping up their infrastructure team in terms of new hires for the bank charter and the Golden Pacific Bancorp ecosystem in general. And as early as last month, they also bought Technisys, which we talked about last week. That was a $1.1 billion acquisition, which was an all-stock deal. Obviously, all of these acquisitions are going to dilute current shareholders. They're going to increase the stock-based compensation as a percentage of total revenue, but it's going to pay dividends in the years to come because it's going to provide more stability, it's going to provide more revenue, and it's going to provide a bigger moat to the offerings that SoFi has as an end-to-end fintech platform. So to wrap this video up, there's huge competition in the fintech space. There's huge competition in the tech space. If anything, COVID and the lockdowns have made one of the most aggressive hiring markets in the tech space. I'm personally in the tech space myself, so I know firsthand what crazy amounts some companies are offering for top talent. Startups specifically use stock-based compensation to incentivize top talent, to ensure that the best of the tech sector work at SoFi and not at the Amazons and the Googles and the Apples of the world, right? They want to put together the right team in place to help them grow fast. I understand 24% stock-based compensation is very high. I'm not skirting around that fact. I agree it's high. And I'm going to be keeping an eye on this number going forward, obviously. But I believe that this is going to drop because revenue rises faster than the stock-based compensation rises, as we mentioned in that last slide. As a percentage, it's going to drop. And I think a lot of it came from the acquisitions as well. 3 acquisitions in 2 years, that's a lot of money spent and invested in this business. As those subside and we hypothetically have fewer acquisitions in the future, obviously that stock-based compensation is going to fall as a percentage of total revenue. And so just to wrap it up, from a bullish point of view, if SoFi was hiding these numbers and not really commenting on them, and there weren't any clear reasons for this stock-based compensation to be so high, I would be hesitant myself. But for the fact that they openly mention them in earnings calls and they talk about the acquisitions and the hiring spree and where all that money is going, I'm not so concerned myself, especially because top management, directors, executives, Anthony Noto himself, they've personally been buying SoFi stock at these levels themselves. To me, it seems as if it's just the price to pay for a fast-growing company, especially one that is as ambitious as SoFi's roadmap is. But obviously, this is a negative statistic to see. You want to see businesses lowering that stock-based compensation and overall just lowering all their operating expenses as a percentage of revenue. I don't want to hide that fact or diminish it in any way whatsoever. But in this video, I just wanted to, number one, bring it up, and number two, justify why I'm still holding SoFi and still bullish on the company despite this statistic itself. Thank you for commenting and just bringing it to my attention. I really love videos where I can dive deep into specific metrics like this. If you have more points on SoFi specifically, do drop them in the comments, let me know. I also have a free Discord. SoFi is something that we talk about pretty often in that Discord, so make sure to join it. It's going to be in the description below. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.